Capital calls are a crucial tool in the world of private equity, enabling funds to maintain liquidity and seize investment opportunities. But what exactly are they, and how do they work? Capital calls, also known as drawdowns, are requests made by fund managers to investors for their pledged funds. These calls serve as a bridge between funding agreements and actual fund availability, typically used in private equity and real estate funds. When structuring a capital call, fund managers include several key elements. These include the names of investors responsible for funding, the percentage of unfunded commitments being requested, detailed payment instructions, reasons for the call, and clear deadlines for compliance. Many funds now use electronic platforms to manage these notifications efficiently. The importance of capital calls cannot be overstated. They allow funds to secure funding for ongoing or new investments, guaranteeing growth and liquidity. By operating on a just-in-time basis, private equity firms can respond quickly to investment opportunities that might otherwise be missed. Capital calls offer several advantages. They enable dynamic liquidity management, optimize investment timing, provide investor flexibility, and reduce carry costs associated with excess liquidity. These features make capital calls an indispensable tool in modern fund management. Typically, capital calls are used when a fund needs capital beyond its immediate funding sources. This could be to expand operations, continue a project, or purchase assets. The notice period for capital calls is generally more than 7 days, allowing investors time to prepare. Recent trends in capital call management include the use of digital platforms for automation, aligning calls with environmental, social, and governance standards, and leveraging data analytics to predict liquidity needs more accurately. However, fund managers must be cautious to avoid common mistakes. Issuing capital calls too early without a specific investment opportunity can lead to unnecessary overfunding. Additionally, relying on capital calls to cover regular operational costs rather than investments is generally discouraged. It's worth noting that capital calls come with potential risks and challenges. These can include investor defaults, issues with deficient documentation, or complications arising from sovereign immunity. In conclusion, capital calls play a vital role in private equity liquidity management. They provide funds with the flexibility to capitalize on opportunities, manage short-term funding needs, and maintain operational efficiency. Understanding the structure, benefits, and proper use of capital calls is essential for both fund managers and investors in the private equity landscape.